Hello, everyone. Today on the Final Bar, a special event, we're going to focus on sentiment indicators. Sentiment is essentially the way that you get inside the head of other investors, understand what they're thinking, how they're voting with their minds, how they're voting with their feet. So there are different ways using survey data, using positioning data, that we can try to understand how investors are thinking, where they're positioning themselves, and anticipate market turns as a result of all of the above. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every day for the Final Bar, and especially for this event. We recorded this a little bit ahead of time, wanted to capture some thoughts on sentiment indicators. And essentially, when I think of my market approach, my macro approach, we've mentioned on the show a number of times, there's three levels to it: price, breadth, and sentiment. Price tells you, the most important information, because price is a representation of the collective buying and selling decisions of all available investors, right? It's how we are pricing in expectations for the future. And that is best represented with the price of any asset, the price of the overall market, or of particular stocks. Secondary to that is breadth, which is all about participation. We recorded another special on breadth indicators, which I'd encourage you to check out on our YouTube channel, where we focus on measures of market breadth, which essentially tells you, all right, if the market is doing X, what are all the stocks that make up that market actually doing? Are they confirming or denying what you're seeing from the underlying price movements? The third piece for me is sentiment. And, for me, it is certainly not the most important, but it is probably the best way that you can get anecdotal information about what investors are thinking, right? I think, as I mentioned, price, I think, is the best indicator of what people are thinking. If you want to understand if people are desperate or euphoric or nervous or excited or despondent or panicked or whatever adjective you want to throw in there, price will tell you, right? Because the price goes up and down based on that collective, interest in better buying or better selling of an asset. But sentiment actually tells you something deeper. It sort of gives you that anecdotal evidence to see, try to understand a little bit about how excited people are, how nervous are they, are the things that people are saying in a survey reflected in the price itself. So I think it's very difficult to use sentiment as a standalone indicator. Any of the things we talk about, I think they're very valuable relating them back to the underlying price. And that's why, for me, it is the third of three very important, steps to the or legs to the stool, if you will. So what we're going to do is look at a sentiment indicator chart list that I've created. I'm going to go through a series of charts and just show you what they represent, how to interpret them, how I use them to try to quantify investor behavior, and then what they're telling me right now. And we're recording this in early December of 2020. So give you a sense of what the sentiment indicators are reading right about now. Now, this chart list we're using is called Sentiment Indicators. To get this chart list, if you're interested, go to your dashboard, and then on the right side, you see chart lists. If you go to the very bottom, and I have quite a few lists here, but if you go to the very bottom, you're going to see a little button on the right called Manage Chart Packs. Click on that guy, and you'll see this one, David Keller's Morning Coffee Routine Chart Pack. If you hit install there, the green button that will appear for you, that'll basically add all of these chart packs into your own login. And the sentiment indicator chart pack or chart list that we're using is just one of a series of other ones. There are breadth lists, global ETFs, industry chart lists, all sorts of different things that I'd encourage you to download and explore and see what you can find. And of course, take them, tweak them, do whatever you want, make them your own. So this is the chart list that we're going to use. We're going to start with the VIX, which is the volatility index, or the fear gauge. Again, we'll go through each one of these and see what we can see. So, when we're talking about the VIX, essentially this is the volatility index. It's from the CBOE options. And so there are a couple different VIX measures or volatility measures that people use. The VIX $VIX is the most common, which is essentially using options to value or to determine how to determine volatility, to measure volatility. And the general concept is the higher the volatility, the more fearful people are. And because when people are sort of buying and accumulating shares of something over time, if you look at, say, much of the year 2019, you can see the volatility remained relatively low in the form of the VIX. This is sort of a slow and steady uptrend as people were slowly accumulating shares. As things went on, it was not a very noisy market. It was sort of a slow and steady trend going to the upside. That's because as people gain confidence, and again, anecdotally, as people get more comfortable with the market going higher, as they understand it, they slowly accumulate shares. When you get really nervous and the market starts rolling over in February and starts selling off and breaking down through support, people don't slowly panic and very gently and calmly sell their shares. They panic, they freak out, and they dump everything or dump a lot. And that's why, Ralph Ekampora, one of my mentors, and many before him have said, the market takes the escalator up, but the elevator down, right? It, slowly climbs its way up the stairs. But then when people sell, you tend to sell everything. You tend to get out and cut your losses, lock in your profits, whatever it is. So there's a reason why the trend tends to accumulate more slowly and distribute much more quickly. So a spike in the VIX, any spike in the VIX usually coincides with market downturns. You can see here going into the December 2018 low, the VIX sort of accelerated to the upside. Even a pullback in July to August of 2019, you can see the VIX went higher. Here in 2020 in February, you see the VIX shoot up as the market sold off. And to be honest, the volatility there got to unprecedented levels above 80. It's pretty rare that the VIX has been anywhere near there. But just to be clear, an increase in the VIX is, it's not like they are perfectly inversely correlated, meaning the VIX goes up when stocks go down or stocks go up and the VIX goes down. It's not a one-on-one relationship because it's a measure of volatility. And sometimes the market accelerates to the upside on greater volatility. June is maybe a good example of that. After the VIX sort of bottomed out in early June, this is at the market top. Wrong period. I'm looking at August here. As I was saying that, I was like, that's not the right point. Here we go. So if you look in August, the VIX was relatively low. It was down around 22 or so. Then you can see the VIX turns higher, and this is as the market accelerated into the September peak. It's sort of an unusual move because they do, in general, tend to move inversely to one another. This is one of those scenarios where they actually moved in lockstep. They actually both moved to the upside. Because remember, it's a measure of volatility. There can be increased volatility in an upturn. It's just not as common. What you would see more often is what you saw here in June and what you also saw there in October, which was a pullback in stocks, an increase in the VIX, showing people were fearful and distributing shares. That's sort of the most common relationship that you will see. So what does that mean about where we're at right now on the VIX? Well, in general, because these move inversely, you're basically looking for increases in the VIX as a sign of market downturns, decreases in the VIX, especially when the volatility is very low. That tends to mean we're at the end of a slow accumulation phase, which tends to be just before a bit of a pullback. If you look at where the VIX is right now, you can see I was highlighting this a couple weeks ago. The VIX was down around 23, 22 to 23. And if you look back, it's a similar level to where we were in August, which was soon before the September peak. Same place where we were in June, which was right at that June market peak. Both of those times, obviously, still overall in an uptrend, but meaningful pullbacks within this cyclical uptrend. What strikes me now is the VIX is down almost to 20. This is the lowest it's been since last February. So, is it possible that we would just have a slow and steady uptrend continue ad nauseum to S&P 4000 and beyond as the VIX gets down to 12 or 15? That is technically possible. I think that's unrealistic given the overall elevated volatility we've seen. Look at the VIX here in 2019. You can see in general, it's sort of in that 12 to 20 range on average. Then you can see once February happened, we've been in more of an accelerated or an increase in volatility state, ranging from around 22 up to 42. So, the fact that, the idea that this might be it for an elevated VIX and we go down, while possible, I don't think that's as probable. I think it's more likely that we're at the lower end of the VIX, similar to previous short-term peaks within this uptrend, which tells me the acceleration to the upside is a bit overheated. It's a bit overdone. We've gone so far up, the volatility has decreased so much, more than likely we'd see an increase in volatility on a pullback in stocks. We are overdue for a pullback by any measure I could come up with as we continue to, push above the 3,600 level. So at some point we have a correction, and I think the low VIX that we see right now certainly tells you that we are at or near the point where that would make reasonable sense. So that's the volatility index, the VIX. And in general, we're looking for, increases and decreases in the VIX, and especially a low VIX level, given where we've been at over the last year, usually suggests a decrease in volatility precipitating or preceding a pullback in stocks. The next chart we're going to look at is the AAII Survey, the American Association of Individual Investors. Essentially is a survey of a couple hundred individual investors. The average respondent to this is a retired man in probably his 60s or 70s, investing his own retirement account, although of course there are many other people represented. That's sort of the anecdotal standard person responding to the survey. So the reason why I say that is there's one definite caveat to this, which is it is representing a relatively small subset of the overall investing community. Younger investors tend to be underrepresented. Women, I would imagine, tend to be underrepresented in the survey. I can't really think about what else demographically. It's just to this is not a perfect profile of the entire investing community is my point. But it definitely is interesting because it's been running for so long. So you have some really good historical data that you can refer back to. So what we do with the AAII survey is the question is, are you bullish, bearish, or neutral on stocks for the next 6 months? That's the way this weekly survey is asked. Comes out every Thursday afternoon. You get the new weekly reading. What's interesting, and so this is the way you quantify it. You have the bullish reading here in green, the bearish reading in red, and then at the bottom it shows you just the difference, bulls minus bears. So the net, bullish or bearish respondent. So what we can do is say what percent of the respondents were bullish, what percent of the respondents were bearish. What's the difference between those two? Let's look at the data and what it's actually been telling us recently. As the market has come off of those March lows, when people talked about this being an unloved rally, I think the relatively low number of bulls, and again, on average, it was about 20 to 30, 35% bullish, which is actually relatively low for a consistent bull market like that. It was sort of it was surprising given the huge upswing after the V bottom. You didn't have a big upswing in a bullish reading. Essentially was telling you more that that investors were relatively unfavorable to this to the rally. And I think the other way to see this is the fact that it was about 2 to 1 bears to bulls there for much of the year 2020, especially in the spring to summer months. So again, on certain days, you'd have 20-25% bulls and 45 to 50% bears on that same time. So many more bearish respondents than bullish respondents. That has all changed in October to November, and you can see this upswing that you can recognize in the bullish rating as it's gone consistently higher. There's a big spike a couple weeks ago. This was in the first week in November where you had over 50% bulls, and that's actually pretty rare to have that many bullish respondents. One of the question marks as the market accelerated, sort of tested 3,600, wasn't getting above there, was the fact that the AAII survey was not elevated yet, right? At bull market tops, if you look back at the 2017 to 2018 peak, you can see that there were 60% bulls in the one survey. So there's an acceleration of bullishness as the market really made that last move to the upside. We didn't really see that. We finally got that a couple weeks ago, which for me starts to suggest we might be in the later stage of this bull market move. The difference between the two is actually net bearish for much of the year. After about late February all the way through mid-October was the first time it finally went net positive, meaning there are more bullish than bearish respondents. That's an interesting data point. I'm much more interested in the extremes, and talking with people like Mark Young from Wall Street Sentiment, he agreed that while the net difference is an interesting data point, the most compelling data points are the extremes. A lot of bulls, very few bears, or the opposite. That's what tells you that we are at extreme levels of polarized sentiment when many respondents are leaning one way or the other. We've pulled back a little bit, so it's still around 47% bulls versus bears as of last Thursday here, the last week in November. So overall, again, still very much favoring the bullish side. I think the fact that we became so extremely, what I would call euphoric here a couple weeks ago, tells me, again, we're sort of at the later stages of that uptrend. If we would continue higher up here with no pause, that would be a very unusual move relative to the historical readings on the AAII survey. The next chart we're going to look at is the NAAIM Exposure Index and the Rydex Bull Bear Index. This is, when you think about survey data, this is telling us what people are saying. You ask the question, are you bullish or bearish? And they respond, and you take that survey data and you capture it over time, and that's how you can measure how bullish or bearish people are. With positioning data, you're actually doing something a little closer to price. You're actually saying, looking not at what people are saying, but what they're actually voting with their capital, right? Are they buying or selling? Are they positioned more bullish or bearish? So this is the difference between what people are saying and what they're actually doing with their money. And if I had to follow one, I would probably follow this more than anything because it tells you what people are actually doing. The NAAIM Exposure Index are the black bars here at the bottom, this weekly histogram, and that's the National Association of Active Investment Managers. So they have a group of active money managers, mutual fund managers, wealth managers, things like that, that manage active portfolios, and it's what percent they are allocated to equities. So it can go down to zero theoretically, although I don't believe it ever has. It can go above 100% if you include leverage, which is possible. So, in general, over 100% on this reading would tell me we're sort of at that euphoric stage, at the later stage of a bull market cycle where people are so bullishly positioned that they're leveraged long, which in a normal sort of process of a bull market phase, you don't tend to see that. You'll tend to get readings sort of the 70, 80, 90% of equity. Over 100% tends to be pretty extended. We've only had that reading a couple times over the last 5 years. We just got this reading a couple weeks ago for the first time. So right when the AAII survey was extreme bullish over 50%. The NAAIM Exposure Index was above 100% for the first time in a little while. You also had over 100% readings here in early October. This is on just before the last pullback. In August, right before that September peak and the pullback there, we had an over 100% reading. Before then, you just touched 100% here in December of 2019. This is about a month or two before the pullback there. Before that, and the blue line is showing the current level. It's not 100%. This is 100% here. In June of 2018, you can see that there. In December of 2017, you can see going back some of the times when we've been there. So it has not always been the top, right? The ultimate top. So for example, in February of 2017, we got above 100%. But again, the market pulled back for the next 3 or 4 weeks before resuming the uptrend. So the upside indicator that we've seen here, the fact that it's over 100% is similar to previous pullbacks. It's also similar to some major sell-offs, but not necessarily. It's actually, one thing that tends to be fairly consistent is a bit of a pullback after that sort of reading. I don't think we've seen enough of that yet to react to that over 100% reading, which again tells me that when I talk about euphoric sentiment, this would be another particular thing I would think about. At the bottom, we have the Rydex flows. So this is basically the Rydex fund family, and they break down their funds into bullish funds and bearish funds. And it's bullish funds and sector funds are on one side of this. On the other side are bearish funds or cash, and sort of grouping those together. So are investors more on the long side or more short in cash, defensive side? And essentially, this ratio is plotted inversely so that it lines up more with the levels you would see from the NAAIM Exposure Index. So if it's very low, that means people are in the denominator. They're heavy in the bearish and cash. Sorry, the opposite. If it's very low, that means that the number is very low. That basically means that they're into more of the bullish positioning. If the number is very high, if the indicator is very down visually, if it's at the lower end visually, that means they're pretty bearishly positioned. So if you look at the flows, essentially during bull market phases, people get into the more bullish positioning. And again, the idea is when it gets really high here, when the indicator gets really high, when the value gets really low, that tells you that bullish, people are really bullishly positioned, and that usually lines up with more of a market top. When the market sells off, people tend to get defensive. They tend to get in cash. The indicator gets relatively low, or the value gets higher, which tells you people are more on the defensive side. I have found that At market bottoms, this is a little tougher to read because the indicator will be very different. So at the 2016 low, you saw the indicator went very, very low, relative to where it had usually been. Because you can see shallower pullbacks here in 2018 at the low and in the March 2020 low. So, you can use it for extreme bearish, indications, but I don't know if there's as consistent of a read. When people are sort of all in, similar to the NAAIM Exposure Index, and we're down below about 0.1, 0.15, which is at the upper end of this range, that's at an extreme bullish positioning right now. And if you bump this line up just a little bit, you can see it's pretty rare that we've gotten anywhere near this level. The last times we've gotten this high on the indicator would be December of 2019, which was again about a month or two before the peak. Back here in January of 2018, which was right at the peak, and that's it for the last 5 years. So again, both of these are kind of similar in that they're looking at positioning from active investment managers for more individual investors. If you think about the Rydex flows, you're measuring how much people are positioned in bullish versus bearish, opportunities within the equity landscape. Both of these readings right now, with the NAAIM Exposure Index over 100% equity, with the Rydex flows below 0.1 or around 0.1, these are extreme bullish readings, and it usually tends to be in the late stages of a bull market cycle. This is after there's been enough of a run to suck everyone in. Kind of everyone's bought. The anecdotal last buyer has made the trade, and who's left to push the price up, push the price higher is sort of the overall expectation there. So here we have the price with the NAAIM Exposure Index and the Rydex flows, and it gives you a sense of how investors are positioning. And again, looking at it right now, you can see overall we're at the relatively elevated positioning. The last indicator we'll look at is the put-call ratio. So this is again going back to the options market, and essentially what percent are people in put options versus call options. And there are different versions of this. There's a total put-call ratio, which is what is it? $CPC, I believe. Yep, that's $CPC is the total put call ratio. We also have $CPCE, which is what we're looking at here, which is equity options only. So it's essentially looking, for options. Are people putting, taking bets more on the put side or the call side, and what does that mean? And in general, if you look at the indicator, it moves inversely. It's kind of similar to the VIX if you think about it. When this is very low, that means investors are betting more on the call side than the put side, meaning people are expecting further upside. When you get a full upside reading, that means people are betting it on the put side, which means the level gets increased and says that investors are overly bearish. So, are people overly bearishly positioned, which tends to happen at the market bottoms? Are people overly bullishly positioned, which tends to happen at the market tops? And if you look at this pink line, which is the raw data is in gray, you can see it's pretty noisy because it comes out every day, so it sort of fluctuates a great deal. So I smooth it out with a 5-day moving average, and that's the purple line. The pink line that you see here is a 5-day simple moving average of the put call ratio. If this line is very low, again, that's a low put call rating, tends to coincide with market peaks. When the line is very high, it tends to be a very negative positioning, negative rating, tends to coincide with market bottoms. Similar to other sentiment readings, market bottoms are actually pretty hard to capture, only because there's essentially an unlimited downside. Sort of like if you saw the VIX spike up to 25 and you thought, wow, that's the lowest, that's the highest the VIX has been in forever. That's clearly a bottom. The VIX actually went up all the way to 80. And the same thing here. If you look back through 2019 and you saw put call ratio around 75 and you'd say, wow, 75 again here in March, that must be the bottom. You miss the fact that the put call ratio can be much more elevated than that. At bottoms, a lot of times it's a little more consistent because there's less panicking. It's more about the slow accumulation. It's more about the trend that persists, and that's what gets the put call ratio to this very low level. If you look here in June, we have a put call ratio of around 0.4. You can see that coincides with the June peak. Again, in September, we had around a 0.4, 0.41. You saw the same thing in October. Don't look now, but we are right about at those same levels that we were in some of those previous market tops. So again, each one of those did not say that was the top and we're going to retest the lows or anything super negative, but it's essentially we're at the level of very low put call ratio, which tends to coincide with market peaks, especially if you look back through the last 6 or 7 months. Since the March market bottom, a lot of these indicators have become recalibrated. You see the VIX overall is much more elevated. You can see the put-call ratio in general is much lower than it was in 2019. As investors are more on the bullish positioning, but now we're at the point similar to previous market peaks in 2020. So for me, that's once again sort of suggesting an extreme bullish positioning, an extreme upside sentiment, and upside expectation. And when so many people are that bullish, that tends to mean that the anecdotal last buyer has come in. So that is a put call ratio. So again, what we did here is we review some of these charts together. The idea of sentiment is to think about the overall idea of what investors are thinking, trying to quantify that investor psychology. For me, it's the third most important piece. The price is number one. What is the overall trend? Breadth is number two, right? What's the participation or the stocks that make up those indexes? The third, and also very important, is the sentiment indicators, which is basically telling you, anecdotally, what are investors thinking, either through survey data or through, positioning data, right? Looking at options markets, looking at put call ratios, looking at NAAIM Exposure Index, and trying to quantify how they're positioned. And all of these things, for me, if you see how I'm portraying them, how I'm describing them, I don't think of these as timing tools. And there are plenty of people that do certainly think of them more as timing tools. And again, that's certainly an option. It's not the way I tend to think of it. I tend to think of sentiment data as more anecdotal. I didn't mention this in the introduction, but when I first really got convinced that sentiment was of value, when I worked at Fidelity Investments, we had the chart room, which is this beautiful physical repository to market history. And one of our most popular charts was a magazine wall, and essentially showed in major market turns what magazine covers would tend to proliferate. And when the market would get very depressed, like 1979, there was this famous cover called The Death of Equities. It was on Business Week, if I remember right. And eventually, it essentially had a paper airplane crashing, and the paper airplane was made of a stock certificate. And the idea was, the thesis was basically, this is the end of equities as we know it. Equities are no longer a viable asset class. They're not going to go up again, or not going to generate the kind of value that they did in the 60s. This is coming out of the 70s, which is obviously a pretty painful secular bear market. Of course, soon after that, you had the biggest bull market in U.S. history, the 1980s into the 1990s, and accelerating into the tech bubble in early 2000. When the market gets really positive, you get very bullish covers like GetRich.com, The New America, The New Economy. Those are all covers from the tech bubble era, sort of late 99, early 2000, talking about technology shares and internet stocks going to the moon and never stopping, because there's it's a sort of a new paradigm. And in general is very bubble-like. We saw the same thing with the housing bubble, with other characteristics where covers get very bullish after the market. The trend has played out. Very bearish as the trend has played out to the downside. So the reason why I think these indicators are helpful is they play off that anecdotal evidence. And if you want to learn more about sentiment, there's a book by Humphrey Neal, Neill, and it's called The Art of Contrary Thinking. It's a great read, easy read, but is one of the best contrarian thinkers. Really popularized this idea of contrarian investing, meaning when everyone's bullish, you want to start selling or think more, bearishly positioned. When people are super panicked, you want to be accumulating, and you want to basically go against the trend. And one of the best ways of measuring the trend is by looking at popular media, looking at magazines and periodicals at the time he wrote that. But now we can use other things. You can look at all sorts of other evidence. And what's really cool about what we have now is we have access to sentiment indicators to really tell us, quantify how investors are actually positioned. So when I'm looking at these sentiment indicators, just to wrap up this conversation, just to review, first off, we have the VIX, which is the volatility index. This tells us how fearful the market is. And in general, a decrease in the VIX, a lower read on the VIX, tends to coincide with market tops, because there's a decrease in volatility before the panic, before the distribution, the move to the downside. The second thing we look at was the AAII survey. This is a way of measuring, quantifying investor sentiment. Are they bullish, bearish, or neutral? And looking at extremes in bullish readings are most common or most helpful. The NAAIM Exposure Index tells us the National Association of Active Investment Managers, are they bullishly positioned? Over 100% tends to be fairly bullish. We also have the Rydex flows telling us our individual investors really more in the bullish or bearish positioning, both of those at what I would characterize as euphoric levels. Finally, the put-call ratio is a way of measuring investor positioning in the options market. Relatively low put-call ratio tends to coincide with market tops. Folks, that's our show for today. I hope you enjoyed this walk through the sentiment indicators on StockCharts.com. Check out my morning coffee routine chart pack if you want to download all of these charts and a lot of other helpful chart lists to help yourself understand price, breadth, and sentiment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.